about what are the messaging and how are you reacting and how are you getting buyers to convert, and a couple of other questions that I've got prepared. So very excited to do the mastermind as well afterwards. So as we're getting our Facebook going,
we have no audio.
Peter, we have no audio on Zoom?
Yeah, we're good now.
Okay.
We're good now.
All right, guys, all fixed. So I'm going to start out with our quote, and then we're going to jump right in because I know, and of course we'll talk a little bit too, but I know that there's a lot. In fact, let me ask you this question before we even get started. What's the inventory situation here? Because I know nationally it's actually down again week over week.
So it actually went up this last week. And so just by a hair, not by much.
Yes.
And so we had a bunch of new listings hit the market last week. People were kind of waiting until the end of March, third week in March, right around spring break time to get their homes to market. But inventory actually went up this last week.
Did you guys feel that? Yeah. Awesome. Of course, we're feeling the multiple bids and the buyer demand, and mortgage purchase applications also went up. So while they go up together, that's supply and demand. So we know that we're going to continue to have a push on prices. So here's my quote for today. It seemed relevant given the fact that we're all dealing with some state of trauma, right? It's whether it's a personal trauma, it's just an economic trauma, whether it's an out there, it's a them trauma. But whatever that is, there's just a lot of news going on that's affecting the psyche of our buyers and sellers, and it's impacting how we do our jobs. How do we get to market? How do we convert buyers and sellers? How do we communicate and present? So here was my quote. I asked God, why are you taking me through troubled waters? He replied, because your competition can't swim. So we have to think of ourselves in an opportunity when we're feeling burdened by the stress or the unknown, we're feeling fear. We have to know that we've been challenged to do something difficult. And by doing that thing difficult, there are others who won't do that thing. So we have the ability, and I know we have the strength to do it. So we're set up for success.
Nice.
Right?
I like it.
Yeah.
It's a good quote.
I missed you.
I missed you last week too. It was so weird. I got the report out last Wednesday. So it's like, well, I can push it out a day early because I'm not doing the update. And so there's nothing to hold on to.
Right.
And so I was like, I'm not trying to stimulate people to get to the webinar. So I was like, we'll just go ahead and publish everything on Wednesday and get it all out. So hopefully you guys caught everything. I didn't have anyone reach out to me on Thursday and say, hey, you didn't send it out. But yeah, I got it out early last week. So
nice.
Up early, 4 o'clock in the morning on Wednesdays, pulling data, doing my thing before the kids get up.
Yeah. And then we sent out a video on Friday. If you guys did not see that, we posted up on social on Facebook, and then we sent out our Friday text if you're not signed up for that, because Friday's when all the shit started to happen. It really started on Wednesday, but it really started to take form where you could define it and see what was happening and how it was impacting the interest rates on Friday. So although we weren't together, we were definitely communicative.
Yes.
Plenty's going on.
Yeah. Like 3:30 in the morning, I got a text from Nicole and I caught it at 4. And so I was just like, oh my God, we really start way too early.
We do.
Way too
if
early.
You have in our sphere, you have to have the notifications, you have to have them off, like, right? All my friends know that. My team knows that now too.
Yeah.
I'll start pounding stuff. I need you to see this as soon as you get in the office.
Yes.
Text them.
Nice. That's awesome.
Yeah, you'd love being on my team.
Oh my gosh. I'd be up for it. I'd be totally up for it.
Be up for it.
Let's go ahead and pop into it. Let's get this going. Got a lot to cover because we're going over 2 weeks worth of data. So let's get this out there and whoa, hold on just a sec. No, don't do that. Okay, come on. Hold on just a sec.
A little screen sharing wants to sit right on top of the presentation.
All right, look good? Everything look good on Zoom?
Yep.
We're good? Okay, cool. So this covers the week of the 8th through the 14th. I'll go over last week's for you too, so that you guys have those numbers in your head just based off of what happened last week, since we didn't talk about it too much. But looking at your strategy sheet pre-COVID 2019, I've been talking to a lot of agents that are like, I'm just uncertain as to when to list. Yeah. And the best thing that I can do is go back to what we were looking at from 2013 through 2019 to try and figure out when the best time is to be in the market. And so I look at the inflow and the outflow of transactions. I look at average days on market, median days on market, percent of close to list price ratios. I look at the supply of inventory broken out by month, price reductions, and how prices ebb and flow going from month to month. And I put this together and it's comprised of over 800,000 rows of data to try and figure out when the best time is to be a seller in the market. And every time the column turns more red, that means that we're in a better time to be a seller and it's going to be more competitive. And if it turns blue, that means the market's cooling and it's going to be less competitive at that point. So we're getting into our March, April, May timeframe right now, where this is really where the rubber meets the road. And this is the best time for you to be a seller in this market. Now it's kind of funky right now. We've got spring break going on right now, depending on which county you're in. I think Douglas County is on spring break right now. So Douglas County might be a little bit slower. Jefferson County is next week. And I think that some of the northern communities are next week. My kids are in private school, so they're the last week in March. And so the market might get a little bit weird, but what happens is a lot of people end up spending that spring break time home with the kids, and they're sprucing their home up for sale to list it in April. And so our new listing inventory starts to really shoot up in April timeframes. And so I would say get that listing to market as soon as you can. Try and avoid spring break where you are. If you have to list over spring break, I'd recommend getting it to the market the week before spring break, the weekend at the beginning of spring break rather than the weekend at the end of spring break, because you start to see more inventory come online. But that's when I would recommend getting your listings to market. I'm not really a fan of May listings. Think about all the stuff that we have going on in May. People get really distracted. We've got Cinco de Mayo on a Friday, so people might be out partying it up instead of looking at houses that weekend. Then we've got Mother's Day the following weekend, and then following that, all of the graduations from preschool through high school and college. Then we have Memorial Day at the end of the month. And so the market really does start to shift as we get into May, where the market becomes less competitive. But it is kind of nice because we've got some of the comps to go through and support some of the earlier market activity where prices are going up. And so I know that there's been a lot of appraisal challenges going on lately. And so this weekly report can be a really good help for you if you're trying to overcome a low appraisal, to talk about how much the market has sped up just in the last 2 to 3 weeks, because an appraiser can only go off of the comps and not necessarily what's happening right now in the marketplace. So hopefully this will give you some of that information that you guys can use to go through and get this information out. You share on the wrong screen? Yeah. Okay.
It's easy.
Okay, cool. Awesome. And so I do go through and build these strategy sheets up for you guys so that you can see how they go each week. And I've got it going back to 2020. You know, it was so funny. I started putting together this particular report back in COVID, because I was like, oh my gosh, everyone's losing their mind. I've got to have a weekly update so that people know what's happening on a weekly basis, because things were changing so fast. And I thought that I'd slowly be able to step out of doing this report, because it takes time to put everything together. And then I ended up with like 10,000 people on my distribution list for this report. And I have 2,000 people that register for this on a weekly basis. I was like, I'm doing this until I die. Like there's absolutely no way I'm going to be able to get out of doing this report. So it'll be a weekly report for your heat maps going forward. I'm actually looking at adding more content to it. I've been in discussion with the MLS system about getting a data feed so that I can continue. I don't know if you were aware of this or not, but your MLS system is going to be changing towards the end of this year. So keep an eye out for that. Make sure that you get trained up on that, but I don't know what the system is going to look like. I haven't had a demo of it yet, but I've been assured that I'll be able to continue to produce these reports, so there will be no disruption there. Looking at our heat map, you can see that as I tack on a new row each week, the market continues to heat up. And so what was kind of interesting this last week was our active inventory actually went up. And I typically don't start to see our active inventory go up until we get into about April timeframe. So people are listing a little bit earlier this year. Now, with the recent drop in interest rates, I'm curious if people will start to list, or if they'll really push to get their listings to market while the interest rates are lower. I don't know if they're going to be lower for a long period of time, or if this is a blip on the radar, or what's going to happen with that. But I would definitely take advantage of the lower interest rate environment now, and that increasing your pool of potential buyers and pushing those listings to market right now. But last week, our inventory went down last week, and we were down by about 4% headed into the weekend before this last one. But this last weekend, our daily active count was up by 3.8%. We had about 3,700 total available listings for sale. Now, again, what the media likes to glob onto is that we have twice as much inventory this year as we did last year. The truth of the matter is that we would need to have 28,000 available listings for sale in order to offset the amount of demand that's in the marketplace right now. So even though inventory is double what it was a year ago, we don't want to go back to 2022. That was a horrible, hard year. And so again, we don't want to go back to that insanity where you're getting 25 offers on a property and things are going 8 to 10% over asking price. I've been going through and I've been trying to reach out and connect and thank all of the people that send me business on Mondays and Tuesdays and ask them how their transactions are going and what they ended up looking like. And we have this kind of interesting phenomenon where there's some people that are saying, I got multiple offers on my property, but they were all under asking price. That was happening about 4 weeks ago. Now, this conversation right now is we're going about 2 to 3% over asking price. And I'm hearing it's about a third to 35% of the listings are going for multiple offers right now. I think that's much more sustainable and healthy, and that mimics kind of what we were looking at from 2013 through 2019 as we went into our spring months. But again, it takes a lot more to get a home under contract this year than what we've seen in previous years. It's so important that you guys are exercising all of your skill sets and getting that listing perfect and ready to go to market, because we have also this kind of syndrome where we're in no man's land.
Right.
You're either under contract the first weekend or you're sitting on the market for a month and making price reductions. And so it's super important that you're pricing it right, that you're staging it, that you're pre-inspecting, that you're correcting issues on the home, because people are at the top of their debt to income ratios and they don't have money left over to go in and renovate these properties right away. They've got to wait probably 3 to 5 years before they're able to go through and make renovations on the property. So they have to live with it in the condition that it's in. And those homes that are turnkey and that are staged and show beautifully are the ones that are selling and going under contract in the first weekend. It's those ones that are not, where the seller's really pushing their price, or if they have iPhone photos up of the listing in the MLS system, that are sitting on the market and they're not going under contract in the first weekend. Pending transactions ended up going up by about 4%. We're putting about 1,100 units under contract a week right now. Usually in the month of May, we end up putting the most number of units under contract on a weekly basis, but the number of units going under contract has definitely grown. New listings were actually down this last week by about 1.7% versus last week. They were actually up by about 3 or 4%. And so we do see more new inventory making its way to market, but with spring break being this week in some of the different school districts, we could see that lag of people waiting to list until after spring break. But I really do expect new inventory to really start to pick up as we get into April. I've had a lot of questions about back on markets, and back on markets are still about 8 or 9% of our overall inventory goes under contract, falls apart, and then comes back to market. Historically, that's a low number. Usually for back on markets, before we hit COVID, it was like a 15% fallout rate. But it's really weird because I've got a couple of kryptonite files right now at First American where they've been under contract like 3 or 4 times.
Oh, no.
And we're just praying that they get to the closing table, but it's one issue after another keeps popping up. Either buyer's financing falls through, they find an inspection item, buyer ends up getting cold feet and terminating the contract. But could you imagine selling a home 4 times? That's, yeah, that sounds a little bit stressful to me, but they're going back under contract pretty quickly if they do have to come back to market right now, which is really great. 4 times. Well, I have one that's 4 times right now. Looking at the odds of selling, it was up last week. We ended up hitting, it was about 66.7% odds of selling last week, which was an increase over the previous week by about 3%. But this last week, it ended up going down because our active inventory was a little bit higher this week. And so our odds of selling was down by 1.3% week over week, and it was sitting at 65%. That's a really healthy number for what I expect to see during the month of March. If you remember pre-COVID, the highest I'd ever measured this number pre-COVID was about 61%. And so the fact that we're sitting at a 65% odds of selling in an environment where we have a 6 to a 7% interest rate is really interesting to me. I'm encouraged to see some of those numbers. Honestly, if you would have asked me what I thought back in December about how the spring was going to go, I was going to be really downtrodden, but I've been actually really pleased with a lot of the numbers as they come out and as I've been reviewing them. So 65% odds of selling if you put up a listing last week for the next 30-day period for the likelihood of you going under contract. Looking at where we should be for a balanced market, again, we should have about 28,500 active listings right now to offset demand, whereas we only have about 3,700. So that means that we have about 13% 10% of a balanced market right now. And this is what keeps us insulated from having the foreclosure, short sale, HUD home properties making their way to market, where if a homeowner does find themselves in a level of distress, they're able to list their home quickly and get out from underneath of it and walk away with the equity that they gained.
Yeah.
The only people that I'm really concerned about are those people that might have bought at the top of the market last year that could be in jeopardy of losing their jobs this year. I do have one short sale that I'm working through right now, and that's the exact case. As they bought at the top of the market last year, they ended up losing their job and they have to get out from underneath this house. And so I only have one that I know of, but again, we're not day trading homes. There aren't a lot of people that bought a house last year at the peak that are ready to sell again this year. They're going to stay in those homes 5 to 7 years. And again, if you expect a nominal appreciation rate at 4%, they're going to be just fine within a matter of 3 or 4 years, right?
And depending on the house that you bought that you're now underneath, I mean, you might consider, yes, you can bring it to market and you can probably sell it and get away without having to do foreclosure, maybe a short sale. But what about renting it? Like, what if you actually converted that one into a rental and then moved into a smaller, less expensive rental short term until you could put yourself back in a position where you could afford it? I mean, I would overturn every stone before I'd be willing to sell a property right now.
Yeah,
Yeah.
definitely.
Yeah, especially
Right.
if you're locked in at a low interest rate, especially. Yeah.
I
Just
know.
go hide out somewhere for a year, have a year lease that covers the mortgage, move back in, get reestablished. Try to think of a plan B.
Yeah,
Yes.
definitely. Showings this last week went up by 5.4%. So people were really out there shopping this last weekend. We ended up seeing that there were about 15,200 total showings that were set last week. So that means that your shows per property should have been about 4.1 shows per property per week. So your shows per listing ended up going up by about 1.5% to about 4 shows per property per week. So if you're not getting your 4 showings per property per week, it may be time to consider a price reduction at that point. I'm having more and more people reach out to me for showing reports. You are always welcome to reach out to me for that, and I can run it based off of your zip code and your price range, how many showings happened at your price range during the last week. So reach out to me for that information. I'm certainly happy to take a look at that, so if you can know, because pricing is really challenging right now. I mean, where do you find comps? How much do you adjust for? What do we think it's going to go for? And again, looking at all of that stuff that just went under contract and leveraging that knowledge of the agents that are also listing in your neighborhood. Right now, we're kind of pricing based off of what's active in the marketplace and not based off of what recently closed, because average home prices going from January to February went up 4%. And so now what comps do we use in order to try and establish and figure out what happened with this pricing strategy? Looking at where we are for shows to contract, we were looking at about 14 shows to go under contract. Again, more buyers are looking at more properties this year than they did last year before putting properties under contract. That went up by about 1.3% from data from last week, and it was about 14 showings to go under contract last week too. So if you've had a total of 14 showings and no offers, that could be indication number 2 that you might need to make a price adjustment. Now, last week, homes were on the market for a median of 7 days before going under contract. This last weekend, it was up to 8. So we ended up hanging out 1 extra day in the market. Now, that could be because there are more multiple offers that are happening, and final offers are getting accepted on Monday and then going under contract on Tuesday rather than on Monday. And so it could be because people are looking through more multiple offers right now before putting it under contract on Tuesday instead of Monday. I'm getting high order volumes on Tuesdays. Historically, the way that title orders flow in is I get the bulk of my weekly orders on Monday, second most on Tuesday, and then it goes down from there. And then I have a pop again on Thursday and Friday for those new listings coming to market that people want to try and put under contract before it goes into the weekend. But I have seen an uptick in the number of orders that I'm getting on Tuesdays, so which leads me to believe that there are more multiple offers that are happening out there that we're not necessarily able to record yet. I get really frustrated with looking at closed transactions because that's a better indication of what was happening in the market 30 or 45 to 60 days ago, rather than looking at the pending transactions. And so this report's unique in the sense that it looks at pending transaction counts. So this is about as live time as I can get this data for you guys. So you had about 8 median days on market last week when we were looking at average price points, which is around $725,000 right now. Price reductions are on the decline again. They ended up, well, they were actually up ever so slightly this last week. It was about 28.6% of what went under contract last week ended up making a price reduction. Historically, price reductions are still kind of on the high end. We're still making a lot of price adjustments out there, more than what we've seen historically from 2013 through 2019. I would expect that number to be closer to about 20 to 25% making price adjustments based on historical data. But again, it's down from, we were looking at nearly 60% of homes at the end of the year making price reductions. I'm happy that that number is coming down and we're not having to make as many price reductions right now. The size of the price reduction is also down. At the end of the year, we were making like 8% price adjustments, which were huge in our marketplace. Based off of data from this last week, it was about a 5.3% price reduction. That's right where I want that number for March for an average price reduction. As we go into April and May, the rate of price reductions tends to decrease and the size of the price reduction ends up going down as well. So hopefully that we continue to see that trend, but it was about a $35,000 average price reduction, $35,500 average price reduction based off of what went under contract last week to go under contract. Now, again, I tracked this out for you for $500,000 price points. We're at 27.1% of our overall market is under $500,000 right now. You can see that this market is continuing to heat up. It was a banner week last week for our units that were under $500,000. We're now down to 0.5 months worth of inventory. And that means that when that number drops below 1, that we have more buyers in the market than homes to sell those people.
What was it for the total market?
I don't think that I said that number for the total market.
I didn't hear it.
I missed it. It was 0.8.
0.8.
0.8 months worth of inventory for the overall market, but 0.5 for anything that's under $500,000. Again, in an environment where we had interest rates that were hitting up to 7%, it put a lot of downward pressure on the market. So those people that were going to buy the $750,000 house are now buying the $500,000 priced house. And so we're seeing more downward compression and a tighter market for homes that are under $500,000 right now. We had about 900 average daily active count. This inventory came up as well week over week by about 2.5%. New listing inventory was actually down 4.5% week over week. We only had 338 new listings, but we put 437 units under contract. That went up week over week by 9.3%. So buyers really got out there last week in the under $500,000 price segment. The odds of selling for under $500,000 right now is 75.3% odds of selling. And so again, that number is really high. Last year, we peaked out probably in about March and April. And last year, we were up to like 87% odds of selling. So the fact that we're at 75.5% odds of selling is a little bit crazy to me. I didn't think that we would achieve such high numbers for the odds of selling, even in the under $500,000 price point. In this market, we only have 7.8% of balance. Again, we only have about 900 available listings for sale. We should be closer to 11,500 available listings for sale that were under $500,000 in order to offset demand. We're looking at about 6.6 shows per property per week for under $500,000, and buyers are looking at about 13 homes before going under contract. So this market is more competitive. Buyers are looking at less homes and putting them under contract more quickly. Median days on market last week was 7. Now we're up to 8. So again, I think that it's more a function of the multiple offers than it is additional time on market, because they're not going under contract and that those homes are going under contract on Tuesday instead of Monday. Looking at price reductions, we saw 26.4% of them make price reductions last week, and the average price reduction was larger at 5.7% versus last week. It was only a 4.6% price reduction. So there were some really significant price reductions that happened last week in order to get these homes under contract. 500 to $1 million, this is 60.2% of our overall market. I think that this is really our most interest rate sensitive category. So I will be really interested to see what happens going into this weekend based off of rates falling this last weekend, if buyers get on top of that and get stuff under contract. And so this is the one that I watch most closely, because this is, again, the largest percentage of our market overall when I look at it by broken out by price ranges. This market actually ended up cooling just this last week ever so slightly, but we're still only sitting at 0.8 months worth of inventory with about 2,000 available total listings for sale. We're putting about 558 total units under contract each week. That went up by 1.3% this last weekend. And so I want to see that number jump. I hope that people respond to the lower interest rate environment and that they put properties under contract this weekend. And so I'm really hopeful that we start to see more of that. New listing activity only went up by 1.2% this last week. So we put about 609 total units on the market based off of data from last week. Now, the overall odds of selling ended up declining this last week. Last week, we were at 66%. This week, we were at 63%. And so again, we had slightly higher inventory this last week, and pending transaction count only went up nominally. And so our odds of selling ended up coming down this last week. I hope to see that number continue to rise as we get into April and May. I was part of a national webinar that was giving out forecasts for what we were expecting in the market, but this was before we had 2 banks crash and maybe 2 more on the way. But they were concerned that we were going to peak in February or early March and that the rest of the year would slide. And I was like, oh no, I'm getting out of title insurance if this is the case. Like, I can't live like this. This is just too much stress and it's like not enough transactions happening right now. But again, it's been interesting to see, but now in light of that, and I'm going to rely on Nicole to tell me more about what's happening with all of the lending environment stuff and the banks failing and what that's doing to our economic system right now. But that completely changed the environment to see those interest rates come down last week. In this market, we only have 14.1% of a balanced market. We were looking at about 3.7 shows per property per week. So looking at about 4 showings per week. And it was about 14 showings to go under contract. So if you've had a total of 14 showings and no offers, might be time to consider that price reduction. Median days on market has held flat for the last 2 weeks at 8 median days on market. Looking at percent of price reductions was 31.1% of the homes decreased their price, and the average price reduction was about 5.1% or about $36,500 off of that original asking price. For 1 to 1.5 million, I start to really shrink my market down once I go over $1 million. For 1 to 1.5 million, this only represents about 7.6% of our overall inventory. And what's really interesting is when you go over $1 million, 40% of those buyers are cash transactions right now. So they're not as sensitive to what's happening with interest rates. So this market has been heating up.
Or they're putting a lot down.
They're putting
what we're seeing.
Yes, definitely.
Less
And so our month supply of inventory dropped from 1.2 months last week down to 1.0 months worth of inventory. And so that declined week over week by 10.5%. So again, if this number drops below 1, that means that we're going to be in multiple offer territory for our over $1 million segment. And this market really starts to hit in April. So again, we could see these multiple offers that are coming out to market even for the over $1 million price segment. Average daily active count, we have 356 total units available for sale on the market, and that was up week over week by about 6%. When you're looking at the graph, you can see that blue line that kind of runs through everything. You can see that we've been on an upward trend for our active inventory, but pending transactions, my gosh, people are sucking up these properties right as they come on market. We had 85 new listings and we put 84 under contract. So
all but one, yeah.
all but
Which
one.
We're already seeing them.
One under
bids.
contract. Yes.
Yes.
Yes. We're seeing
Yeah.
multiple offers in this over $1 million segment, but pending transactions went up week over week by 18.3%. So people are putting these properties under contract very quickly. The odds of selling in this market went up 3.7% week over week. And so we were sitting at a 57.5% odds of selling in this particular market. So I was thrilled to see that number where if you're listing these properties that are over $1 million, the odds of them going under contract in the first 30-day period is more likely than not, which is great.
So you need to celebrate your $1 million listing.
Yes, so we just need more $1 million listings out there. Everyone get on that, please. In this market, we're even more shallow than the $500 to $1 million segment. We only have 10.8% of a balanced market. In this market alone, we should have about 3,300 total units available for sale versus the 356 that we have currently available for sale in our market. marketplace. We were looking at about 3 shows per property per week. That's been really consistent for the last 3 or 4 weeks now. So if you're not getting 3 shows per property per week, it may be time to consider a price reduction. And it was only 13 showings to go under contract this last week. So if you've had a total of 13 showings and no offers, maybe time to consider a price reduction. Median days on market was down to 8.5. Last week it was sitting at 12. So median days on market is shrinking. About 3 weeks ago, we ended up hitting about 5 median days on market for this particular price range. So it's a little bit longer. We're looking at just over a week, but overall, that's a really fast transaction for $1 million property here in Metro Denver.
With interest rates still in the high 6s.
Yeah.
Right. I mean, so people have just gotten used to it.
Yeah. So they've adjusted, which is great. We ended up seeing that only 25% of homes reduced their price in this price range, and the size of the price reduction was only 4.5% this last week. That was down significantly. Last week, it was like an 8.5% price reduction. This week, it's like a 4.5% price reduction. So it was a significantly smaller price reduction this last week. Last price range we'll look at is 1.5 to 2 million. This market, I can't remember, it cooled down this last week. So we ended up having our average daily active count increase by 6.1%. So we had 157 total units available for sale. Pending transactions from last week to this week fell by 47%. So that was a big change and shift, but we only put 18 units under contract, which pushed our month supply of inventory back up to 2 months worth of inventory versus the last 2 or 3 weekends. It had been bouncing between 1.2 to 1.5 months worth of inventory. So a lot of people kind of put on the brakes this last week for this over $1.5 million. What do you think? It could be. I mean, a lot of properties in Douglas County is one of our more expensive counties. And so it could be that people are on spring break or gearing up to go on spring break. New listings were down by 7.7%. So people are waiting to put their homes on the market. We ended up seeing the odds of selling week over week fell by 14.2%. Last weekend, it was 57.6%. This weekend, it was 43.4% odds of selling. So hopefully that number pops back up this weekend if people are using loans to get into these properties in the more favorable interest rate environment. Even though we saw a slowdown, we still only have 16.7% of a balanced market. We would need to have about 1,000 available units for sale between 1.5 to $2 million. We were looking at about 2.2 shows per property per week. It jumped up to 19.6 showings to go under contract. So people were out there looking, but they weren't putting stuff under contract this last week. So maybe it was just a bunch of turd listings that went on the market between 1.5 to 2 million last week that people didn't want to go under contract, but there was not a whole lot that was happening. It slowed down last week for sure. But those units that did go under contract were only on the market for 6 days. So median days on market was really fast for those units that are great and turnkey and show ready, going under contract very quickly. Of those that did go under contract, only 17.6% decreased their price, and the average price reduction was about 9.3% from the original price. We had a couple of questions pop up. Let's address those, and then we will get this going. How can I sign up to get these reports emailed to me? If you registered for this webinar, you are on my email address list until you die. Okay. And so you will get a copy of this automatically just by registering for this class. And I'll probably be sending that out around 4 o'clock this afternoon. I'm in back-to-back meetings. Before we go to the next one though, if you don't see it in your inbox, a lot of our stuff, both Megan and mine, will go into junk. So definitely check your spam or junk if you're not seeing them. Do you think Easter weekend will be slow like other holiday weekends? Yes. Usually over Easter weekend, we end up seeing the market decline by about 10 to 15% in terms of pending transactions and total showings that end up going on. I am told a 1% rate drop qualifies over 1 million buyers. More demand with low inventory is not good. Do you think that with the recent banking issues, we will see a rate drop of over 1%? I know you don't have a crystal ball, but curious to hear what your thoughts are on that. And I'll show you what the interest rates are doing on this back half, but we are seeing a lot of volatility and it has dropped. So they were just about to go over 7 again, and now we've dropped down to 6.5, and we're locking in the mid to high 5s with as little as a point. So they've definitely dropped.
So people are out there noticing.
Yeah, I've got people asking what's happening in the over $2 million price range.
Yeah.
There's this really interesting pool of potential buyers that's sitting out there that's in these over $2 million markets right now. And again, they're putting properties under, they find something that they want, they're going under contract with multiple offers if they're in these desirable neighborhoods and they're ready to go. But if they need work and they're not in great show ready condition, they're sitting on the market for like 2 months. It's no man's land in between the two of them. And so you're either under contract the first weekend or you're sitting on the market for a longer period of time. And so I am seeing movement, but you really have to prep those homes to be ready to go for the market.
Nice. That was the last of the questions.
Yes.
So it's a little crazy out there is what you're saying.
Yeah. Yeah,
Awesome.
It's definitely crazy, but more inventory is coming. So that's good. We're happy about that.
It is. And the demand is backed up. So we'll talk about what's happening with the mortgage purchase applications and interest rates. But you got to remember, we had mortgage purchase applications that were going up for 8 straight weeks. Those mortgage purchase application buyers, those prospects are sitting and waiting. I know, because I'm talking to a lot of them. And they're, can you update my letter? We're looking again. We're looking again. We got beat out on that one. We're looking again this weekend. So to say that what's happening on a week over week basis with mortgage purchase applications doesn't quite capture the full amount of demand that's ready to jump when one of these things happen. And then, you know, we saw back in October when interest rates really spiked and they hit over 7.25, the market died, right? Like the fourth quarter, we could honestly say might be the worst quarter in a lot of our businesses. So, but now we almost hit it again. And nobody really seemed to care. I mean, demand slowed down a little bit, and maybe you don't have the flood of buyers that we certainly had last year, but based on the lower supply, things were still moving, and they were still moving at or above asking. So it's definitely a supply-demand relationship that we're seeing going into this next season.
You're not sharing on Facebook.
I'm not yet. Nope.
Nope. Okay.
I'm going to share right now.
Great.
Yeah. So let's go ahead and do this thing. Do the thing?
Do the thing. Let's do the thing.
All right. All right, so I'm going to jump in. Oh, that's weird. Okay, that's me. That's technical. I want to I want to see us on here. So
Well, it's weird because I'm looking up here and I'm trying to make eye contact, and then but I'm watching myself on the screen. So it's just.
But I don't want. I need to knock on wood. We haven't had any technical issues.
No, we were on mute at the beginning, but we fixed that right away.
That we've done at our desk.
Yes,
I know. That's a simple one. But all right, so here we go. I think we've got it shared now. All right, so let's talk about what happened with those poor little banks, because we're up to 5. So we're going to talk about what happened with the 5 banks and what's continuing to happen. So this is why it all happened. It happened because the Fed is going higher for longer, and then he threw on this faster. And that really was the beginning of the end, because you have a lot of people, especially a lot of wealthy people, who have their deposits. And let's just talk about the Silicon Valley Bank, because it's the most well talked about, the most known. You had a lot of wealth inside that bank, well over the FDIC insurance limits. They were also giving loans in a very risky product, the IT startups. So these guys had high wealth and they wanted high returns for that high wealth. So you've got big depositors, and then you've got a bank that has to loan money to give the kind of returns to their wealthy clients. So they're also loaning on these startups. So there's risk on requirement, right? And then you've got the liquidity requirements all banks have to be subject to, that in situations like this, they have to be able to support any depositor who wants to retract their money, who wants to just withdraw that deposit. They have to be able to support that. And then be able to do that, they have to have liquidity. So there's liquidity tests that goes on for every bank. So now something like SVB happening, when you get into a situation where you have wealthy depositors who are looking for opportunities elsewhere, who can get more money for their money, they can put it in short-term bonds, they can put it in other instruments, they can get more money for their money, they're going to withdraw their deposits. When they start doing that, the bank has to start creating liquidity in other ways. And this bank in particularly was highly leveraged in long-term bonds. That was a very safe place to put your money as a bank. 30-year fixed, 10-year treasury yields, MBS bonds, all of those things. Well, you got to think, just a year ago, those bonds didn't, they paid out a small coupon rate because the Fed rate was 0. It had been 0 for years, right? And so to have a Fed rate 0 for years, those coupons were low, and now I have to go sell them, but the market is giving me a higher coupon rate. Now I can get 5%, 6%, 7% on something, but this coupon only has a 2% yield on it. Well, the market doesn't value that bond anymore. Not like it did. It's not worth $100 for the $100 that it was purchased for originally. So when I go to try to sell it, I have to sell it at a discount. And when I sell it at a discount, I lose money. And that's what is the basis for the problem. So not only did you have this bank that was losing depositors, but then they had to sell bonds at a loss. Then it became public that it was a loss. Then their Moody's ranking went down. Then more people were talking about it. My God, with the invent of Twitter, you could have had something like this happen 8-10 years ago. And yes, it would have made the news, but it wouldn't have had a run on the bank if they could have recreated their liquidity in a timely enough fashion, or if somebody would have come in early enough and actually supported them, bailed them out, or bought the bank. And it wouldn't have had a run on the bank like it did in this market, because people are tweeting about it as it's happening, creating all of these wealthy depositors going in and withdrawing all of their money, right?
Mm-hmm.
So now it's just speeding up the process. So all of a sudden, this was happening very fast, but it happens because of this 2 and 10 year inversion. And if you look at this, the inversion is, if I can get the cursor over there, I can't, but it doesn't matter. The inversion is quite deep. You have to go back decades to see that kind of difference between the long-term rates and the short-term rates. So that's what was creating this issue. And that's because of what the Fed was doing. I mean, you can see it if you actually go, and I would suggest if you're still getting 1 or 2% on your savings account, right now, you can get almost 7% on the Series I bonds, which is based on inflation. Inflation is still high. This was up around 10%. Sorry if you missed it last fall, right? Because inflation was at its height in the fourth quarter. So this inflationary bond, people are looking at these, and you can sell this inflationary bond anywhere after a year, and then you don't have to pay anything back if you wait and hold it for 5 years. So it's a relatively short-term bond, and that's compared to a longer-term bond, which you're getting 3.5 to 3.5%. So that's why people are pulling their money out of these situations and putting them into these short-term instruments. So the likely place you're going to see more of a crack and maybe a bit of a panic is in the credit markets. So Jamie Dimon had said this even back in the fall, and Scott Minerd at Guggenheim says they're going to push until something breaks. It broke, right? And the Fed, there were several people that said, I don't know what's going to break. I mean, that's even what Jamie Dimon said. It might be the EFTs, it might be a country. It's going to be something that we don't suspect. Hindsight is 2020. But this speed by which, and I've been saying the speed by which, it's kind of my term throughout this whole COVID experience. It's not the things that are happening, but the speed by which they're happening that's freaking out the markets. So this speed by which the Fed is raising the Fed rate caused something to break. And now we know what it is. It's the banking environment. So we saw Silvergate was actually first. It got very little publicity, but they stopped all trading. They are a very heavily cryptocurrency bank, and they're in California. The bigger one that happened and became more public was in the East Coast. This one is on the West Coast, and they stopped all trading, and they held all deposit, or not held the deposits, but they stopped anybody from continuing to make any deposits or make any loans. So Silvergate was actually the first one. You just didn't hear about it. It didn't go as widely public. Then Silicon Valley Bank happened. That one is where we started to hear the news. That started on Wednesday. And then we find out that the owner, the CEO of Silicon Valley Bank, actually sold over 3 million of his stock just 2 weeks before. And he's actually part of the Fed board in California. You'd think he'd know what he should and shouldn't do. Maybe he did, and he just didn't care. Well, that's going to come back to bite him now. So the CEO of Silicon Bank sold his shares. Then he tried to raise more capital. It went public. They got downgraded by Moody's. The stock plummeted. And then, of course, we had a run on deposits. The bank, the FDIC came in on Friday. they took it over, and then by Sunday they shut it down. So, and then of course we all saw, I don't know if you guys watched Biden come out on Monday morning talking about the fact that we're going to insure everybody, nobody risk. We do not want to run on banks, which was the right thing to do. And then he quickly got off stage because I don't know that he could even answer a question at this point. Signature Bank then was the other big one that is on the East Coast. That's another cryptocurrency bank. The FDIC came in and over the weekend shut them down as well, took them over, shut them down. All the depositors are protected. Now we've got 3. Then over the weekend, so before Biden came out, but of course this was part of it, he talked about the fact that they created a new bailout, right, which created a 1-year loan to any other banks. So forget about Silicon Valley Bank, they're toast. Forget about Signature Bank, they're done. We're talking about any new banks, any banks that need to sell bonds on the market for a discounted price because the coupon rate isn't as good. Don't sell it. The FDIC will come in and insure it, will give you the cash for the face value of that bond so that you don't have to sell it, you just hold it. We're going to give you a loan for 1 year. What does that say? That says that I expect the interest rates to be lower in a year and you're going to be good, and that face value is going to come back to par and you're going to be able to give me back my money. Markets rallied on this. So not only did you see that this massive movement over from stocks to bonds happen because of this flight to safety, but then you also saw people buying bonds because they believed that we were also going to be out of this. We're going to see lower inflation, lower interest rates in a year's time. So now all of a sudden it became favorable. Now the stock market's a whole nother conversation that I'm just going to ignore because some of my money's in there too. But so that's the kind of thing. So we saw interest rates dropping on Friday, then really dropping on Monday because this came out, and they don't want to call it a bailout, it's a quasi bailout. Credit Suisse then came out, and that was yesterday, Wednesday. What's today? Today's Thursday. Holy crap!
This week has flown by.
No. When you have like news coming at you every single day and multiple times a day,
I'm so overloaded. I just had to turn the news off. It was too much. It's too much.
I'm just like
a lot.
I'm just soaking it up.
Like I just need to watch Real Housewives for like 30 minutes.
I literally pull out my hair.
My boyfriend loves it.
No, all right. Credit Suisse happened, but of course they got bailed out right away. So they said that they're borrowing up to 54 billion from the Swiss National Bank. They're fine. They didn't see a run on their bank at all, but of course they had a huge issue that broke the news. The markets didn't really actually like that, interestingly enough, because they're like, enough. Like, I'm starting to really freak out about this. So you see these drops, right? So that was on Wednesday when the first bailout or the first bank started to drop. Then on Friday, it happened again as we're realizing that the FDIC is coming over. You see this flight to safety happening. And as this flight to safety is happening, so let's talk about the flight to safety for a second. So if I'm the bond market and I have more buyers and I have a relatively fixed amount of bonds to buy, what happens to the price of those bonds? We're in real estate. We know when more buyers come out for a limited supply, the price goes up, right? You have multiple bids. So the price is going up, the yield or the interest rate, the effective interest rate goes down. Because a bond has a fixed coupon rate. It's fixed. It doesn't vary like the stock market. That bond has a fixed coupon rate. So if the price I have to pay to get that fixed coupon rate goes up, then that bond is really no longer worth, maybe it's $100 at a fixed rate. I had to pay 110 to get it. So the effective yield is lower, right? Because I had to pay more for the same interest rate. So the effective yield is lower. Our mortgage interest rates went down. So we saw that. They went down on Friday. They went back up on Tuesday. I'm sorry. Yeah, they went down on the 10th. They went down again on the 13th. They went up on the 14th when we got news about Credit Suisse. The bond market was like, I'm a little freaked out. I'm scared about this. And then they started going down again on the 15th. So we're seeing this flight to safety based on the banks. We're seeing, oh, I'm sorry. Let me retract that. Our interest rates went up when the CPI data came out. It went down again. The fourth arrow, the third down, is based on Credit Suisse. So I want to correct myself before I get too far. Sorry about that. All right. So it went down with all the banks and it went up with the CPI data, which we're going to talk about in just a second. Because if it was a CPI data alone, we would actually see the Fed raise the Fed rate 50 bips. But we probably won't see that based on the bank's failure. Now this morning, we're getting alerts that First Republic is facing a bailout. So that's yet another bank, and that's here locally. So they're going to swarm to that. They're going to bail them out, and they're going to protect the depositors. But it's a lot. It's a lot. So, and we're going to talk about that during the mastermind afterwards. Is how are you talking to your clients about this, and how are they talking to you about this, if they even are? So the 30-year fix, we saw it drop. So it was teetering right above 7% again, and it dropped to 6.5%. It went back up with the CPI, and then it dropped again with Credit Suisse. So we're seeing this volatile movement, but interestingly enough, it's volatile right there. Like people are talking about, well, how much lower is this going to go? We really still are dependent on the inflation numbers and on the wages. So that is, and every time, so it goes back when as the older the bank news gets, the more we'll return to this being an inflation-driven interest rate environment. The banks just created a massive opportunity. It could be a week from now, if we don't get some good news on inflation, it could be that interest rates start creeping back up again based on the news at that time. So the last time we did this conversation was 2 weeks ago when we had the slide deck, and we were talking about 4 more rate hikes because Powell had come out saying that we're going to raise the rates higher for longer, now faster. The market took it off the table. We saw the interest rates starting to go up again. And because he was talking about 4 more hikes this year, then we're not going to drop them again until 2024. Well, that changed a lot because now not only are we not talking about 4 more rate hikes, we're probably only talking about 1, maybe 2, but then we're talking about drops. So it's really interesting. By December, we're expecting it to actually have dropped a full percentage point. Totally different story based on the bank news. Now, the question is going to be, is that going to come true? Because this, remember, I mean, it just changed from 2 weeks ago. It changed from 4 days ago. It keeps shifting. This is just an expectation of where we think the Fed is going to go. And with each bit of news, it shifts again. But watching this unpack will help you also talk to your clients to go, okay, we're going to lock in a rate. Demand is already spiking up. We're seeing limited supply. We're going to see multiple bids. If we go in $25,000 over, is it still going to work for your budget? Because within the next 6 to 12 months, you're going to have an opportunity to refinance that mortgage and put it back into a position where you want it to be. But between here and there, you got to be good. And I got to make sure that you're good, right? So we are expecting a 1/4 point raise next week on the 21st and 22nd. Of course, we will see. There's a lot of debate. Some people are even saying that we'll see nothing, that we'll just keep it at 4.5 as far as the Fed rate goes. Remember, if we keep it at 4.5, the prime rate 7.75. We got HELOCs. A lot of people are talking about, how do I pull some of the equity out of this home? How do I take advantage of some of this opportunity? There's always opportunity when others are scared and fearful. There's opportunity. But right now, those HELOC rates are high. They're based on the 7.75. But if those start coming down, if the prime rate, or if the Fed rate starts coming down, the prime rate starts coming down, the HELOC rate starts coming down, and so does the consumer credit card debt interest rates. So about 1/3 of the people think that it'll go nowhere, and 2/3 think that they'll raise it 1/4. But the 50 bip hike is off the table. They are in their blackout period, so we won't know until the 21st or really the 22nd when Powell comes out, and he'll be coming out on the 22nd at noon. So if anybody geeks out like I do, I will be watching it. They have their own YouTube channel.
Oh, all right.
Yes,
Great.
it's very exciting.
Great.
The CPI came out, which actually put a push up on our interest rates, but really it was relatively flat. It did exactly what we expected. It just didn't drop. That was the problem. So we were actually up 0.4 month over month on both the headline and the core, but it was the shelter costs that was in there that propped it up. Fuel costs came down, but the away from home shelter costs went up. Somebody's cooking bagels.
I know. Who's cooking?
So my oldest son, I'm gonna tell a story right here. So we had a house, his bedroom was at the top of the stairs, and we'd have like a baby gate at the top of the stairs, and the couch was at the very bottom of the stairs with the TV. And Peter and I, we had one son at that time, one kiddo, and well, I guess we had two. Elijah was born. So Elijah would get out of his toddler bed, and we'd be downstairs cooking popcorn and watching movies, and he'd at the baby gate. What's that smell, mommy?
Oh,
What's that smell?
that's so cute.
Go back to bed.
Not popcorn.
What's that smell, team? All right. So the CPI number, that was random.
Yeah, I like it. You got to throw those in every once in a while.
That happens when you're in person. All right. So CPI went up a little bit. Core services went up. This is not good news. If this was all we had, and we didn't have the bank failures, with 100% certainty, the Fed would have raised the Fed rate another 50 bips. And the break that happened last weekend would have happened that next weekend, right? So it's just a matter of when it was caught. The Fed, remember, works off of data lags. So they're not looking at the current information, and they're not even really business people. So this impact on banks really was a surprise to everyone. All right. So we're seeing how big that housing gap is. If you drop out that housing gap, that's going to drop CPI quite a bit. And we're already there. But the shelter costs inside the inflationary numbers are higher than the real shelter costs today. The cost of rent is coming down, but that's not showing up in the CPI. PPI came out and it actually dropped. We estimated that it would be a 0.3% increase month over month. PPI is the wholesale. So think about the fact that if you're a farmer and you're milking cows, you got the milk, you're putting that milk through a conveyor belt and on the trucks. So that's PPI. What does it cost you to manufacture that product? And then that product makes its way through shipping to the store, and that's CPI. That's the consumer version. When I buy that gallon of milk off the shelf, that's measured in CPI. But the farmer creating the milk and putting it on the trucks, that's going to be PPI. So we're seeing that this is actually decreasing, which unless they take a ton of profits off the table, meaning they increase their prices before it gets to retail, we should start seeing those retail numbers start to come down. The price is coming down, meaning inflation is going to come down. We all want to celebrate when inflation comes down, because then that means our interest rates will come down with it. Case freight is the shippers, right? That's the truckers. So it's all part of it. So it's the manufacturing of the product, the shipping of the product, and then the store sale of the product. So that actually is also showing it's slowing down. It came down 5.5%. These are just those foretelling that, yes, prices are coming down. They are off their peak. It's just a matter of how long it takes the data to enter into the reports. It is 10:56. We got to the end. All right. So the New York Empire is also down. So all of these are just showing how the manufacturing market is slowing down. Initial jobless claims actually dropped. People still have money, even though Meta is laying off another 10,000 people. Consumers still feel good. Shockingly, I don't get it. They just keep spending and they feel good about it. So consumer sentiment is still up. Mortgage purchase applications went up again, 7% this past week, 7% the week before that. That's why you're seeing those demand. You're getting the calls. Jeremy and I were just talking before we started, and he's like, I've gotten 10 leads in the last 4 days. People are out and people are calling. Builders are starting to be cautiously optimistic as well. They don't have any competition right now. There's no other inventory. You got to go find the new build. They're feeling pretty good about how limited existing home inventory is. And so really taking advantage of these interest rates is going to be the win, and helping our first-time home buyers. With just a couple minutes to spare, I'm just going to share. Remember, down payment assistance is available all the way up to $176,000 in income. So if you've got somebody that's looking for some help and they don't think that they can afford to buy, they need to talk to us, because $176,000 is a lot of income to be able to still support. Conventional CHFA, you can make all the way up to $148,000. That $148,000 also allows you to qualify for a Fannie Mae product, which allows you to wipe out LLPAs if you have lower income. I've been locking a bunch of people on that, all down in the high fives and mid fives. And here's the best news. Fannie Mae and Freddie Mac, albeit this was a point of contention, are not publicly owned nor traded. They are government backed. There is no risk of failure to mortgage lending. So the banks might contract, mortgage lending is still going to be safe. And we all know that when the recession hits and this banking failure could push us into the recession, that's going to drop inflation. That's going to drop interest rates. That's going to spur on buying, because lower interest rates going to create demand because plenty of people still have jobs. We know that. And we're going to see our business tick up. Now, I don't want to go celebrating in the streets about bank failure. I'm just doing a little dance on the inside. Right? I don't know if we can do it out loud. All right. So with that, I'm just going to stop sharing, see if we have any questions. That was fun. I don't know where that time went.
Yeah, this one went fast.
It did go fast.
This is a fast one.
All right. When you reference a price reduction percentage, is that from the original price or the previous price?
It's from the original price.
There you go. Median days on market?
For 500 to $1 million was 8.5 last week.
8.5.
8.5.
Fast.
Yes,
Speed
super
fast.
fast.
Y'all are muted. That was earlier. Nobody else is saying that. What about the Frank Dodd law that Trump eased for mid-range banks? I'm gonna have to talk about that one offline. We're gonna skip that one because we don't have enough time. Fed has their own YouTube channel. Best tip today. Becky's my people. And then can you clarify the extent of the rate drop, high last week and low this week? So we had popped over 7.25 just a couple weeks ago. Then we were sitting at about 6.99, and now we're down at like 6.49. That is an average, right? So I'm just told you we're locked in 5.6, 5.99 with a point. So we're getting into the fives now, but that is an average, and those averages, interestingly enough, typically include points. So people are like, what's your rate? I'm not going there with you.
Anything you want.
It really is.
Give you any rate you want.
Yeah.
Check how much they're charging on the points when they quote you that.
That's true. Yes, you can get buy down to any rate. So you guys that are on Zoom, thank you so much for joining us today. Oh gosh, can you clarify the extent of the rate? I did that. How long can buyers lock? Buyers can lock up to a year. Current months of inventory in the
2 months based off of data from last week.
Do you guys have any questions that we should ask while we're online? Yes.
I have one question. I was at a board meeting yesterday. We were talking about financials and donations. And they were talking about pre-COVID, COVID, and post-COVID numbers. And our new realities, like that you can't look at data the same way you did. And I think that's why Larry Kendall was saying, look at the competition, not comps. Do you find that?
I find that to be true.
Yeah.
Yeah, I agree with that. I'm going to agree with pretty much anything that Larry Kendall says. That man's smart.
Right, but I mean, as far as like almost
Creating a new
discounting
normal.
COVID,
Yeah, you have,
you know, and pre-COVID even, because what we're living in now is our new reality today, and it's unprecedented. Like you talked about the speed.
yeah, this time really is unprecedented. I think we had to just buckle up and we had to continue to sharpen our saw and educate ourselves so that we can be resources for our clients. We don't need to go out there and be the speaker of all of the information. There's plenty of news doing that for us. But how does that news impact the psyche of our buyer and seller, and or the value of their home, or the speed by which they can sell that home? We have to be able to translate the data into something that's applicable and allows them to get active, right? The worst place that a buyer seller can be is on the fence. So either get them on the fence on one side or the other. It literally doesn't matter, but keeping them on the fence and indecision is where people get caught. Right?
Yep.
You want to show us?
Awesome. Yeah. Thanks for tuning in, guys. Thanks for joining us in person today. We really appreciate you. Again, the reports will be emailed out. Nicole will post her slide deck to the Agent Ignite Facebook page. My slides will be emailed out probably around 4 o'clock today.
Yes.
I've got back-to-back meetings going on pretty much for the better part of today. So it's going to take me some time to get the reports out to you guys today. But if you have a copy of the link, the report's already updated. You're just waiting for me to send it to you again. So we'll get everything out to everyone. And hopefully we'll see you guys at our closing tables coming up here in the near future. So thanks so much, guys.
Yes, and
Have a great
absolutely.
weekend.
And I'm working. I'm the on-call this weekend. So if anybody needs anything, don't hesitate to reach out. We'll make sure to get your guys locked in and under contract quickly.
Awesome.
So there you go.
Thanks, guys.
Bye.